What's up, guys? Get it started in a second. Just give me a minute. It's too hot in my house. I'm like sweating. Just give me a sound check. And we'll get it started. Let's change the scene. Main. Dun, 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 dun. Just let me know how the sound is. Let me just double check my sound settings too. Audio. Default. Okay. Sound is good. Sound is Gucci. Cool. Good to know. Say hi to everybody. Cornholio, M.A., Patel, what's up? Hadi. Sweet Canary, long time no see. K1, what's up, Banks? Gerhard, Jason, Nico, Clement, Philip, Nick, Rinsler, Lambert. How's everybody doing? Browner. Cool. Background noise okay? Jimmy Trendricks, what's up, man? Hey, man, gotta speak the truth. It's a non-sensationalist crypto YouTube. So, yesterday at the beginning of the YouTube, I spit the truth. I said, chances are being generous, 10% of people survive to the 3-year mark. That's being generous. I think it's more along the lines of 5 out of 100. 5% of people will find success trading. If you have a bank or a fund background or any kind of institutional background or even worked at a brokerage, that number goes up actually pretty dramatically. It's along the lines of 30 to 40%. So how's everybody doing? What's up, Doc? Zidane. The only name that I could think of with Zidane is Zidane, right? Little soccer. Is that his name? Hopefully I don't sound like an idiot. Meridam. Michael, it's all good, man. Happens. Listen, what you should do in the beginning is, if you have your setup defined, you have your risk defined, your thesis is laid out, place trades and only allow yourself to be taken out of them if your stop is hit or your target is hit. You don't want to start adding too much discretion in, especially if you're a newer trader. If you're gonna lose money trading, let it be due to variance, not due to execution, not due to last minute style drift. But yeah, don't. If you have an idea for a trade, you have your setup defined. Don't get in the way of yourself. Colorado Springs, what's up? Bango, what's up, man? Yeah, absolutely. Having a plan is really important. It's easy to feel like you don't have to have a plan when price is moving kind of slowly. You feel like you could just stalk things and, you're going to have a feel for how things will transition. Having a plan is, something that you absolutely should always have. When you become more proficient, I don't want to say you're able to wing it more, but you have more feel, you have more style. But even then, I wouldn't say that I always have a hardcore plan going into the day. I make a mental note of where I want to get involved, what I want to get involved in. I'll put some Post-its up from time to time. The only time I really have a plan is if we're going into something like an interest rate decision or non-farm payroll or anything macro related where you have to have something that's, I think, importantly, that it's codified and written down. When you write things down, like I said last time, it makes it real, right? It takes it from just an abstract idea and makes it concrete, so you're more likely to stick to it. And it's, when you have a plan and you consistently apply through the use of having a plan, your reflexes are obviously a lot better, right? You're leaning on a plan rather than, when things start moving, you're kind of lost, right? So anyway, hope, sound is good. I didn't see whether or not you said the background noise was all right. So I just want to double check that the background noise isn't overbearing, but I do want to have some sort of ambiance. It's a nice word to say, right? I do want to have some ambiance during the stream. My wife is obsessed with these British period pieces lately, and now it's like Amazon is delivering these books that are from I can't even describe them, but she's always walking around the house. And I hope this doesn't get us canceled as a couple. But she's always walking around the house, speaking in I'll say a London accent. I can't stand it. All right, so sound is good. Cool. All right, so let me just make some adjustments. So I want to just go over yesterday's plan. I laid it out on the stream. I'm going to be doing 5 streams a week. So the benefit of doing 5 streams. Oh, let me just get the formalities out of the way first. So anyway, thank you guys for joining. What you'll notice is that if you're able to participate, it's because you subscribe. So I appreciate you doing that. I made it so only the cool kids could talk. What you have to do is subscribe. But subscribing is not cool enough. I appreciate if you hit the like button. We are trying to do these streams a lot more consistently. I'm trying to stick to my word. You're going to see that I'm going to be really casual during them, because when I don't stream for a while, I start getting all like streamy, put on like the radio voice, and you just sound like a fucking moron. So I think it'll be a nice group for us to, it'll be nice to do this consistently, because it'll be a lot more casual and you just kind of get in a rhythm. But hit the like button. Please hit the like button. We appreciate that. We want to be popular on YouTube, right? We're people. Like, we don't do this because we're passé and we think, hey, I don't care if nobody watches. Like, fuck yeah, I care if people watches. If no one watches this shit, I'm not doing it. I'm not wasting my time doing it if no one watches. So hit the like button. Give me that spike of dopamine. But Josh is going to be doing videos too, so he's going to be doing more recorded series. But I'll be doing 5 live streams a week, and I think it'll be good because I'm not going to have to be really redundant every stream. Where it's like, if I take a couple days off and I don't stream for a week and then I get back on, it's like I got to go over the high time frame shit, and it's like nothing really changes. So I end up spending like a half hour describing that, and it just gets it's just boring. It's bland. So we do streams frequently, and we could just pick up where we left off. And if someone comes in the chat is like, hey man, can you tell me what you think on the high time frame? And I'll be like, dude, watch the other video. I don't have time to do homework for you. Okay? So that'll be good. Like all the streams, everything everything I say, it's just my opinion. I'm just looking at the market through my lens. Goes without saying, this is not financial advice. I don't want you to go hit, the buy or sell button based on what I say. I know it's unrealistic to expect that I won't have some kind of impression. And I really appreciate that. It does come with responsibility though, but please don't do anything stupid, okay? I get messages from people that are like, oh, I thought it'd be a great idea to refi my house and, take out a home equity loan. I took it out at 60, and I'm like, oh man, like, I don't know what to tell you. Like, that sucks. I'm thinking in my head, Jesus, that sucks. That's a life lesson that's going to sting for a little while. Don't do anything stupid, okay? If you want to be a good trader in the beginning, just try not to lose money. I don't care if you pull yourself out of position a million times. And, I was saying just a second ago about, I think Michael said something about, like, psyching himself out of the trade. What are we listening to right now? Come on. This should be stream beats. But, psyching himself out, pulling himself out. That's fine as long as you're not like pulling yourself out after price has gone considerably against you. But if you need to be very defensive in the beginning, so be it. Get really good at not losing money, and then hopefully when you have a system, something you could apply consistently, you'll keep your losses at bay, and your wins will add up over time. Okay. So none of this is financial advice. And then the last thing, if you're interested in any of the platforms I use, I've shared multiple exchanges that you could use before. I share Phemex all the time, partners with Phemex for 2 years. Phemex.trade, have access to spot, futures, and yield if you want to generate yield on your stable coins. If you're a big baby and you don't want to get involved and you just want to be in stables, nothing wrong with that. You could earn a flexible 8% APY, right? So yeah, Phemex.trade. Anyway, let's get into it. Let me see if I have to say hi to anybody else. Greetings from Australia. What's up, man? Sven, what's up? Stern, what's up? Okay. Bang it. What's up, man? Oh, Jocelyn Flores. Okay, Flores. Cool. All right. So anyway, really quick. So the story the last couple of weeks has been one of positioning, where we hadn't seen for a really long time any kind of sustained negative funding or sustained behavior that would indicate to us that shorts were getting a little aggressive in a pretty bad area. So it's a bunch of things that you want to be able to check off. You want to be able to box check certain things before you start making big decisions. And one of the criteria that sometimes works, sometimes doesn't. With alts, it certainly doesn't work at the same threshold. Is if Bitcoin is 50% off the highs, it's like, all right. I mean, at any point now, unless there is something that's brewing, currently in progress, some kind of major catalyst. After a 50% drop, just one way. If we're into a major level, in this case, we're coming back down to the bottom of a range, and we're at a weekly level. I mean, it's not stupid to expect a bounce at some point, right? So to expect some type of mean reversion. And I think it's really important to remind everybody we're still in a higher time frame range, okay? So, at a significant low, at a key area market structure, yada, 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 key contextual zone, inflection point, high participation place, blah, 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 right? Really important area in the chart. Just keep it simple. Approached it pretty one-sidedly. So no major kickback by price at all. Small bounces on the way down. That's fine. There's no reason why, had to bounce here. There was just some evidence that lined up that would make it, would increase the probabilities in our favor. So that on its own is not enough, because if we get to the lows and we just see that it's still derivatives that are chomping at the bit and there's no spot bid and there's no real support, then what we're looking at are people that are very likely to paper hand positions, because derivative products, used by retail and crypto, they're very path dependent, because since there's leverage involved, they can ultimately be a forced seller. So if you had to move all the way down to the lows, and we had to move down to the range lows, and we saw that it was still very much one-sided on the futures exchanges, and let's say basis was blown out, and let's say call skew was blown out, if there was a very prominent spot per premium, that would be a completely different story. But for the first time, this entire structure, we had sustained negative funding down throughout this period right here. And then, like I said yesterday, sort of the last little bit that the market could throw at the low was from non-farm payroll. It should have been terrible. Should essentially open up the runway for the Fed to hike, and for the Fed to tighten. And for the market to rally on that was very telling. Okay. So you have a bunch of evidence setting up for this to be, possibly a major turning point in market structure, and potentially the trend in at least the near term. And just as a reminder, we have trends throughout the structure, but like I said earlier, we're very much still within a range. So it would be reasonable to expect that you could continue to visit even the midpoint of the structure and then continue down, and maybe we end up doing business lower. Not saying that, but I'm just saying that within this structure, we didn't have any kind of really significant pullback yet. So a bounce at this level is not really shocking. I'll just put it that way. So that brings us to where we currently are, and I'm just doing this quick recap. I'm going to start losing my point because I didn't intend on doing this for this long. I wanted to get right into it. Local market structure. So on the way up, we saw that it was just pretty one-sided in terms of funding. So one of the best signs is price moving up, funding remaining consistently negative. And even better, if it is on an increase in funding, right? Not an increase in funding, an increase in open interest. So if price is grinding up and you see that sellers are still trying to aggressively slam the bid and to auction this down, if price is continuously moving up, it just shows you who the heavier hand is. And not for nothing, the smaller participants usually using market orders, the weaker participant, and the opposite side is either someone who's passively bidding up or market maker, and they're not worrying about being directionally exposed, period. So the risk is on the seller at this point, and if price continuing to grind up in the face of that negative funding, it's just showing you where strength lies. Okay, and even for the periods where price was moving up and funding was negative and open interest was declining, you could say that you had a stronger spot bid, right? Might not necessarily been the case that the aggressive selling was due to, right, as we got up towards these highs locally right here. Might not necessarily been the case that the aggressive selling was to open new positions. Could have been very well just longs are being closed out. But still, in the face of rising price, that means that either those longs that have closed out, so those longs that are flat, they have either the decision to short this still on the way up or to enter the trend and potentially get long, right? If they short, they're future long at some point either way, right? Because that's baked in. Anyone who sells is a future buyer, and anyone who buys is a future seller. So anyway, a few things. Equities recovering the 200-day moving average. Just want to get this out of the way. I'm going to get lost if I don't, because again, I wanted to get right into the low time frame stuff. Equities recovering the 200-day moving average. This is very significant. Once you lose the 200-day, you have a significant amount of people that step out of the market. CTAs, trend followers, very systematic types. After you lose the 200-day, what you'll see is that liquidity changes drastically in the SPX, and I'm looking at the ES, which is E-mini futures contracts based around the S&P. So we're back above that right now, and we had this sort of textbook retest of the top side of this range that we were stuck within. So this is looking good. Okay, there's a good case to be made for a decent amount of these hikes priced in at this point. And that brings us to BTC locally. So I have a few areas that are labeled. Get this out real quick. Composite, prior range, composite down here, less balance, more grinding upward activity. Again, this was very bullish because in the face of this upward grind, funding was consistently remaining negative. And again, after non-farm payrolls, it became very obvious who was offside. So if this is very bullish, the top side of this structure should hold. Okay. Ultimately, if something is very bullish, you should see that, yes, you're beginning to shift market structure. We're back above the 20-day, so that's something that I really lean on. It's checks my bias. It's a default move that I make, very systematic move that if we're above here, I'm just regaining exposure if I wasn't able to gain it prior to this and sort of outsmart the market before we got to that point. But above here, close through this level, I am game at least for the short term. Not the short term 5 minutes, but I'm talking about in the near term, in the next coming weeks, right? It's just very unlikely that after a trend of this magnitude, 50% drawdown, positioning began to shift down here. Non-farm payroll right here should have been really negative and price rips up, and now we're back above the 20-day, above market structure. A series of, lower lows and lower highs is now potentially changing. There's a lot of evidence adding up. So a very strong move, if this is going to be a very strong trend in the short term, should just retest the most shallow possible area. Okay, and ultimately this composite, it's a multi-day composite, is now serving as support. So if we hold 43, I'm expecting that we return back up to this 46, 47 and above level. All right, I ended up peeling a little off yesterday and getting re-involved down here. I'm going to go over those trades in a second. I peeled some off yesterday because I figured, well, at this point, and I gave the example of, Tom Dante mentioned this, if someone pulled you out of this trade above 43 before this next logical target, right, or the underside of this structure, even closer, if someone pulled you out of this from here to here, and then this being the optimal area to define this new position, is this an attractive risk to reward? And it's not, right? You're kind of in the, when you're right here, you're kind of in the middle of nowhere. Whereas, this is a good area to define a position. Closer to the high is a better area to define a short. You're just kind of in the middle of a gap right here. Okay, and the initial move up into this level, past the ledge, into a low volume node, is an area that you would reasonably expect would act like an initial resistance for price on the way up. It was an area where price didn't spend much time in the past. We gapped through, returned to that level, retested, yada, yada, yada. So as long as 43 holds, I am completely exposed. Okay, just trading around the position, taking intraday swings on futures, taking intraday scalps as well, on both sides of the ball. I've taken a couple short scalps. I've taken more intraday swings on the long side, where I'm willing to sort of let them ride because, again, my default bias is confirmed now multiple ways. Above the 20, have a big change in market structure down here that I think is very significant. And now, again, back above what ultimately should serve as the most bullish retest. If this is a very strong, the beginning of a stronger trend. So that I think covers more or less the high time frame stuff. So keep it very simple. Just said it yesterday. BTC has put in multiple patterns like this in the low time frame and the high time frame. One final puke, recovery. If it retests like this, the top side of the structure, that's as strong as it gets. The deeper we come back into this structure, the more likely it is that if this is a prior range, you end up, if you lose 43, it's very likely that you just come back down to 41.5 area, right? 41.5, 44, 42. I mean, it's likely that given how bullish the market has gotten in the short term, and it shows that this is still being faded aggressively. We're not seeing longs chomping at the bit on futures products or futures instruments. It's likely that you should just consider that if you have a technical area, let's say it's 41.3, range comp value area low of this structure. If it's 41.3, maybe it's best idea to front run it around 41.5, right? Because you'd have to imagine that if everyone's looking at a significant level within market structure, and this value area high is a weekly level as well. If everyone's looking at the same thing and this is as bullish as we're talking, again, at least in the short term, that level shouldn't be revisited, right? It should be front ran to some degree. That might be 1/2 hour ATR. It might be a couple $100, whatever. I think you get the idea. People should be in a strong trend. It should be that the market is pricing in new information. It's no longer balanced, and anyone who gets involved should be very hasty about getting involved, right? They shouldn't really allow price to pull back too much. So on the low time frames, so I have a few trades that are marked off that I shared on Twitter. So just going from left to right translation, here, up to here. So this trade, so I mentioned this right here, grabbed a quick short, seeing as we started trading below, a little bit of the recent risk tagged on, looked a bit more accepted into yesterday's range. Okay, SPX dropping, that's the S&P, adds to tailwinds. It looks like that tweet is right there. The entry on the trade was 43,650. So the entry on the trade was right up here, or 40. It might have been 43,640, whatever. We could just look at this, right? We could just actually pull that up. I think I could just click on that. Can I? Let's see. Link to tweet. 640. 640 was the entry. So that was a short right here. Okay. Looking at behavior down here. So far this low has seen a good amount of volume across venues. Funding is relatively neutral right now as open interest has dropped for both coin margin and stable coin margin futures. Could make a case for that disconnect being local shorts covering, right? So we had a slight rise in funding, but it was on a drop in open interest across the board on both sides. So what that very well could have been is anyone who got short up here on the way down, de-risking at that 43 level, right? Because that is a weekly level as well, and an area that you would expect to act as support. So just picking up on a few details there, right? And then I ended up mentioning, grabbed a quick long, and I shared these trades on Twitter, entry and all. Grabbed a quick long on the 4-hour close above 43, back within yesterday's, right, or today's value area, excuse me. Pretty well defined. So far, sellers have hit the low with a lot. That was down here, and ended up taking before 43. I think this was actually right down around here, around 43.4 or 43.50. Can't remember. I think I grabbed like 350 or 400 points out of the trade. And then took a short right up here for a quick fade, closed it out right before VWAP. So let's go over the logic behind these ideas. Let me just go through the chat real quick. And these are 1, 2, 3 trades, but I've probably taken 20 trades today. Just trading around price locally. These were what I would consider more along the lines of intraday swings. There wasn't a whole lot to them, but if you look at something like the day's ATR, if you look at, for example, the average sub-period rotation, you see that it's $200 to $300. Well, capturing a 300-point move at that point is pretty good. All right. I think that you should consider that when you are trading yourself. Okay, so let me just look through the chat real quick. The open interest is the amount of contracts that are open. Okay, so a contract implies a long and a short. So the amount of contracts that are open. So if you look at open interest and it's very high, just think about it as a lot of fuel in the market. A lot of, an increase in open interest is an increase in positioning. Okay. So Michael, just looking at your question real quick, how would you validate rebuying if we drop to the bottom of the range? I mean, that would be very discretionary at that point. So I can't sit here and say like, oh, if we do this, I'm gonna buy the bottom, because ultimately it's gonna matter if we get there. What I'm actually seeing in the tape, and actually seeing whether or not there's absorption, who's getting involved down there, right? The point of profile and using something like market structure is to be able to, and you don't have to, so you could look at profile, you could look at market structure, and I also consider, as you can tell, where volume comes in. So I might mark off areas on the chart where we've just had a significant amount of volume come in. And these are just, ultimately areas that I'm going to be looking to get involved. So market profile, market structure, as Linda Rashke put this, so she's a great trader. She wrote Trading Sardines. Market profile, market structure, that's me looking for where I want to get involved. And order flow is essentially why I want to get involved. Okay, so we have an area that we're looking to, and then the participation there is really what counts. Okay, so anyway, I don't have, okay, I thought you meant my aggro was open. All right, so real quick. So first trade, grabbing a quick short. So I have these highlighted. So I think it is actually very important that you mark up your charts as much as possible. So as you can see, as we were funneling down, I was marking off this area, right? So just what price was more or less enveloped in. And that short was right here. Okay, so that short was under today's point of control. Let me just zoom out real quick. Let me see something first, because if I change, hold on one sec. I want to adjust this screen, but I don't want to make this go off screen. There we go. Okay. Now, let me just make this. So half hour. Fuck, actually, wait one sec. I'll just drag that out. Otherwise, I'm going to have to set it up differently. There we go. All right, cool. So just looking at the last 2 days. Okay. So finally, we have a significant move up. Big spike down, right? Trading below VWAP. Okay. As you can tell, yesterday I was talking about getting re-involved at VWAP. All right. So VWAP is all the way down here for yesterday. Session closes, we have a new VWAP. Okay. So when I was talking about this VWAP yesterday during the stream, I was saying this VWAP and this 43 level, so that weekly level and the prior value area high, are a good area to look for a response. Sure enough, we got plenty of responses down there, so that worked out. But it's just important to remember that this VWAP, when today opened, it's no longer that we're looking at this we're still looking at this VWAP to be actionable, right? Because this is just a session VWAP, so it's not rolling, but it still does represent the positioning on average throughout yesterday's trend day. Okay, so again, there was still confluence down there. Now this trade right here, all right, this is an exhaustive move up, trades back within the prior day's range, and then ultimately loses where most of the volume had come in as the day is evolving, and is trading back within yesterday's value area. So yesterday was basically a trend day, but had 2 low volume nodes, right? So here's the entire range, low volume area to start, high volume area, low volume area, higher volume area on the way up. Right? I'm sorry if this is getting a little messy with my drawing. Value, minor value, one-sided trend, right? Gap, really just a gap in between. So it's very likely that after folding over up here, and you have to remember that 45 to 46 was an area where I said was a good area to expect resistance anyway, right? Before any kind of minor pullback, and I ended up saying that I was taking some off early when I took it off back here, right? So I posted yesterday, I'm taking some off early, but I thought 45 and 46 was ultimately the better area to get involved if I didn't feel like I needed to front run, right? Everyone else who was selling as well. And you can see that you never would have got 46. This was a pretty big move down. So this trade is very mechanical, right? You have a trend day, mostly value overlap, right? An exhaustive break that falls back within the prior day's range, okay? And then you're losing and falling back within the prior day's value area. It's kind of like a Dalton setup. It just has a little bit more meat to it because we hadn't had any kind of local high put in yet, right? So this is the value area high of the prior day. This level had initially acted as resistance. And then all we're doing is looking at whether or not on the return up to this level, whether or not we see that there is absorption. So going back here, this is this level on the chart, so the drawing tools are synced. So on the return back up, whether or not we see absorption at the underside of that structure again. Okay, so again, this level right here being the value area high of the prior day. All you're looking at is a Dalton setup. So really, I mean, what you're looking at is this box. Okay? You're looking at a trade that covers from here down to the low of value. But I got out early because we had a pretty thick point of control in the middle, right? And this was a strong trend day. If this is a really strong trend, like I said, you should get shallower pullbacks. You should consider front running what might be, you know, the logical target normally for the trade. So in a Dalton setup, you know, if the trade is, if you have a day like this, here's the value area. Let's say you open out here, rotate back in. Absorption here, usually you're looking at this move across this range. But in a strong environment, it might make sense to take profit at the first sticky area, right, which would be the point of control. And this was a strong trend day, so, I mean, it's reasonable to expect all you would get would be the close of this gap that occurred on the way up. So if you look at the footprint, so I'll go to this right now, so that, let me see, I still have it up here. So we'll just go back. That's actually a lower time frame setting that's more useful because this is going to now, it's going to be very chunky over here. So this is actually the setup right here. This is what occurred, but this is a higher time frame candle. So what you're seeing right here, let me just go over this really quickly because you can see it on, now it's a little bit clearer I think with these TPOs. So here is the setup. Prior day's value area high, meaty point of control, value area low, but it's a trend day, so this value area low is just, it's basically the entire profile. So the setup was a failure at the high, trading back within the range, and then importantly, trading back below today's VWAP, below today's point of control into this whole area right here had a ton of confluence. Okay, so the point of control implies that that's where most of the participation took place. So if you're below it, you can make a stronger case obviously for the bears being in control because all of this represents positioning and the VWAP represents positioning. So without any kind of drastic change in open interest, it's likely that those positions can further puke. So a move back within the structure, so I'll just open this up. Move back within the structure, if you get a retest and you see absorption, usually the setup, like I said, if it was a balanced day, this is a trend day. If it was a balanced day, you're looking at the low of value, but this is a trend day, so really you're just looking at the next sticky area, right? So single prints are a good target as well. So ideally, you should get a single print response. So covering up to this ledge makes sense. But looking at this on the footprint, it's more aggregated on the 30-minute footprint. You can see the first move up we had, you had a ton of buying at the high. Second time, failure at a slightly lower level. And this also coincides with where that diagonal line was that I drew. So in advance, have an idea of where I'm looking to see, you know, whether or not buyers can muster the strength. And as soon as we see that, for one, this level originally went bid. So just think of this right here as the bid rising up. It was able to be sold into. We see a puke, a rise back to that level. Volume comes in. And again, once you start losing volume in an area where you had a ton of participation prior, if you have other confluence, in this case, the value area high of the structure being lost, it's a pretty mechanical setup. So there wasn't a whole lot of brain power that was required behind the setup. And if you look at it on the lower time frame, so I'll just go back on a lower time frame footprint. So here we are. This is what it would look like on the low time frames. Now, I didn't get involved at 43,700, right? I got involved after it started failing and losing the levels that we got involved, that we saw activity come in at. right? So here, for example, is 43.67. Prior to that, we had all the way up to 43.8. I need to see failures, right? I'm not going to just get involved because someone is buying the highs. Like that buying activity is what moves price to begin with. So it's not just a matter of stepping in when you see that people are buying at that level. Ultimately, what you need to see is, let me just go back to it, that you have some type of failure, right? So this is where the activity came in. We saw it happen prior. On the way down, here's your value area. You have this diagonal that had been governing price so far. Once that volume comes in towards the high, once we start failing, I'm just looking to ultimately clean up the low, right? Or rather, just return back to the low. And this is an easy position to define because what you can say is if you're leaning on it on behalf of all that volume coming in, then just get out once we're back above there, right? So if I got involved right here, if we're trading back above here, my idea is invalid, right? So this is a pretty simple setup. Does this all make sense? Let me just look through the chat. So type in www. First. So I like to look at predictive funding just to show how the market is currently positioning. I mean, you don't necessarily, funding is, right, it's calculated based on either premium or discount between the futures market and the spot price. So really what you're just looking at is basis. So yeah, for Blockroots, www.blockroots.com. So you can make a case for absorption really quickly. So we just have a level right here. If you see a ton of volume come in, let's say this is like a weekly level, right? Price returns back to this level. You make a case for absorption when you see that there is a ton of activity coming in. So for example, you get a lot of selling. So I'm going to go over the next trade in a second. A lot of selling below the low, and price is able to hold that level. If we see a lot of selling below this level, and then price on the way back up, we're seeing activity at the bid. So let me look at a footprint again. It makes it a little bit easier. So we'll just go to the next setup because the next setup involved a ton of absorption. No, I am using CVD, but it's not really for lower time frame setups as much. CVD is more along the lines of like looking at CVD's behavior over a more clearly defined range. So I'll look, if we have a structure like this, it's a little bit more even, a little bit more range-like, then I'll be looking at CVD, right? When we're at the highs, when we're at the lows, to see if there's any kind of either, let's say, CVD divergence at the lows, or the opposite if we're at the highs, and upon putting in equal highs, you have a CVD that has completely put in new highs. So no, I still use CVD. So if you look at this is our CVD right here. Looking at CVD. So you saw a ton of selling come in at the low. There was no, it wasn't necessarily the case that you had a range developing across and then we saw CVD going, going very negative. But let's go to the next setup real quick. Sec. So these lows down here are actually a pretty good example. 43 is the level, right? Now, I say this quite often. It's not a quote that I've come up with, but it's a concept of levels to begin with. They're not laser-like. They're not like perfect lines in the sand. It's a loose shoreline. So when I say 43 or when I say any level, it's a zone. Just think of it as a zone. So that's why a lot of times you'll see that I'll have boxes on my charts. I like to sometimes keep it just clean looking. If I'm going to do streaming, if I'm going to stream more, I want to have it clean because odds are I have a few different things on the chart. I'll have the TPOs, I'll have the single prints showing on the TPOs, have a VWAP, I'll have any kind of drawing annotations. Then I'll use just clean lines. Otherwise, I try to just use boxes or understand it as general areas and boxes. When I say why I use boxes is if I say, for example, 33.5 is the level, it's like this instead. So imagine price should have a degree of there should be a degree of noise around that level. we can't say it's not a treasury. We're not like expecting 43.50 to hold on the dot, right? So 43 would be ultimately where you would look for signs of absorption, and sellers just threw everything at the market right here. So if we look at the footprint, so go back to that. So 43 is where you're looking to see, for example, you would want to see that all the activity that comes in continues to push price further down. Instead, it was a lot of back and forth, right? You had buyers and sellers getting involved aggressively. As price moves up, I think you get more hasty behavior to begin with. But it became very clear when we started trading above everybody. So we'll look at a footprint right now. So again, the 43 level, just to begin with, is a meaningful level because it was a prior weekly level. It's a composite prior value area high. And this region also, so remember, is dipping into where a ton of risk was put on yesterday, right? So you have composite, micro composite, or just think of it as like small value within the day, trend move, and then another period of value being established. So if you're going to cover this gap right here, if you're going to cover the prior day's gap, it makes sense to expect that the next area you would see some type of response. It was, again, there's a point of control down there, your weekly level. So what I'm just trying to really hammer in is this area is meaty, right? So it's not going to be, oh, just 43 has to hold. It's easy to describe it that way, right? If you're just tweeting. But if we look at this on the footprint, there was just a lot, right? I mean, the first few moves down, so for example, this is a case right here where this might initially look like a good setup. So you have, this would be more or less a mousetrap setup, right? This is looking at a high time footprint, which is better for swing trading, but you have lows put in on high volume. So for example, right, this is all the wick down here. Candle closed up here, most of the volume at the low. You can see that zero print right there. That means the ask never offered that down. That never went offered, right? So at one point, the ask stopped following. This bracketed area looks like a really good mousetrap initially because when you take these lows out, we had a burp right here. So that burp, right? That burp was ultimately, that burp was a stop run, right? So a fair amount of that was actually just longs being closed out, right? So this would look normally like absorption, right? But it's kind of loose, and this was a stop run. But what you're seeing is here's more or less a range being painted in that general vicinity of 43, right? Right into 43. A lot of volume caught below, and now price is able to do what? Trade higher. Now, what you really would want to see for, to make a case for absorption is that price is able to stay bid once we break back above. So, we ended up coming back down below this level, more selling, more selling, more selling. You still have buying though, right? So that implies that there's passive sellers, right? So you have to just look at this as this is an area where there was a lot of participation. Okay, so sellers are still willing to walk this down and offer this down, right? Look at this. All this buying activity right here, that means that when price was there, it was offered, right? So there's just a ton of congestion down here. When you have something like this, right, where again, it's into a key level, right, you're seeing a ton thrown at the market, right, it's just like everything besides the kitchen sink. When you have a lot of activity into one pocket, you could basically just look at this as its own trigger, the exteriors of it, right? So the highs of the activity, the lows of the activity, and you have a trigger that's like $500 wide, right? This area where you have a bunch of people committing probably pukes once you lose it, right? So in this case, it becomes more defined at this low, right? If after this, right, this candle right here, and I was monitoring this like it was a 30-second scalp, if after this buying activity came in, we traded below 42.7, you would have probably seen this whole thing puke, right? Because at that point, anyone who got involved in this structure is offsides, right? Any passive buyer, any aggressive buyer, it would be very clear that all of this volume that came in, and this is just one exchange, right? All of this volume that came in would be in, you'd be in better fit. It'd be better if you were a bear in that exchange and price was lower, right? You couldn't make a case for anyone who got involved here that was a buyer being in a good position if we were down here. So instead, when buying came in, we were able to trade back above the top side of the structure. And really, this was a lot more nuanced. It was a matter of, okay, now we're able to trade higher, and they're still aggressively selling this as we move up. So what this means is that ultimately, if we see, and we'll go to low time frames where I'm really just monitoring this back and forth. So we'll just get back there. When you see something like this, right? So after you have all of that activity coming in, if we're able to move up and you see volume transacted at the bid, right? So we had 1.4 million contracts here. We had over 1.5 million contracts here. If you're able to tick above that, I don't know, you have to add, I think, a little bit of tape analysis with this just to pick up on the speed of the market. But if you see, and I'll just draw this on a blank chart. If we have, let's say, multiple sellers below the low, right? But you have multiple buyers too. You have back and forth behavior around this area. But now you're able to trade above, and you see that as you move higher, that they're still aggressively selling this. Well, if they sold it and there was no bid, it would slip price back down, right? But if you see that price is now able to move above this congestion, and all that selling that's now also still coming into the market is able to just stay put, well, it's showing you that there's a slight, an exchange of power at that point, right? So that was, again, that setup was a little bit more nuanced. And I think that I was, at that point, I'm looking at the tape, I'm looking at aggr, I'm looking at the footprint, and I was really my eyeballs were glued to the screen as this was occurring because I was expecting this to resolve sooner. Before this occurred, I was actually short, right? So I was thinking that I was going to be selling the breakdown because it just looked like every time that we'd auction up, so I was actually short up to this point. So I transitioned right here, to be as honest as possible. I went from short, closing out that short, to getting long. Because if I'm looking at all of this and saying, these buyers are the reason that, every time we're moving sideways but down, right? So absorption, and by absorption I mean as we move up, buyers are absorbed, and when we try to return back to that level, it's lower this time around, right? We're seeing that the offer is stepping down and absorbing buying activity lower. If I'm leaning on that, then a lot of the times my exit is going to be if we trade back above that level, right? Because there's no longer a case you've made for them being offsides. And at that point, the other side of this, okay, that's an aggressive buy, is a passive offer. And it could be a market maker, it could be some idiot actually offering it down. Odds are it's a market maker, and they're going to be delta neutral. But let's say that this is someone who's actually offering this down and selling this passively. They're offsides if we're trading above them. And, limit orders can get squeezed too. Right? It's just normally we see dumb traders, the less sophisticated traders using aggressive orders. So the last trade is a quick short. Let me just go through the comments real quick. So just think about absorption as effort versus activity, or activity versus results. If you see selling coming into the market and you see increased selling, and this is where an actual CVD comes in. If you see increased selling come in, and instead of having, for example, so I will, an example of a CVD, let's say that, this is prices range, and a CVD is a running total of delta, right? So if this is prices range, right, highs up here, lows down here, and your CVD is doing this, well, there's more buying over here, but price is not making new highs. So that's an example of absorption. And the idea of the footprint is a little bit more granular, but it's the same concept, right? When you see a lot of selling coming into the low, but price is able to trade back above it, well, if you have continued selling and now price is able to still trade higher, it's showing you that sellers are no longer in control, right? And then just the last quick scalp. So I'm not looking at, when I'm scalping, I'm not really looking at, hold on one second, let me delete this. When I'm scalping, I'm not really looking at a time-based chart. I'm looking at something that's more rotational or volume-based. So one of my footprints was a trade or a tick chart. So it creates a bar every 987 trades. And yes, this is XO charts. I will use a higher time frame candlestick chart that's based on time, to know where 4-hour levels are, daily levels are, weekly levels are. These are levels that a lot of the market puts emphasis on, and I think it's important to know those because those are going to be sort of self-fulfilling levels to some degree, especially the really high time frame levels, right? But trading low time frames, I'm looking at something that's either a volume-based rotation or a range-based rotation because it just keeps the chart cleaner. Because as you can imagine, if you're trading the low time frames and there's not a lot of trading taking place, you could print candlesticks when there's actually no activity. So I only want to see, where activity comes in. The high time frame footprint is better for swing trading, so I'll have either 15-minute or 30-minute footprint, and that's just to see, over the course of an area, whether it's an hour-long pullback or multiple hours, could be over the course of a day. If there is any kind of extreme positioning, right? At a low, do we have an extreme amount of selling that's come in? Can I see a material amount of activity at the lows? We have an open interest increase, maybe clear signs of shorts funding being negative or increasingly negative. It just becomes a little bit more visual, and I could lean on it better. And instead of just relying on like a candlestick close, I rely on the actual volume that I'm making the decision on behalf of, right? So let me just draw this to give you an example of what I mean. Triggers are, for most of my low time frame scalps, are based on the volume that I'm leaning on in the first place. So I have to clarify what I mean by lean. So if we are looking at, let's say, a swing failure. Swing failure, highs taken out. A swing failure with not a lot of volume above the high is not a really useful swing failure. So a really good swing failure is when you have, return back to a level over time, break the level, a lot of, in this case, maybe breakout longs are triggered, short stops are triggered, but you get a lot of new participation above this level. So, it could be a really thin move. It's not necessarily a good swing failure if there's not a lot of trapped activity. So what you look at is a footprint, right? So for example, a swing failure on a footprint will be, I'll pull one up real quick just to make it a little bit better visually. Let's go back to just a high time frame chart. We'll use this as an example. So this is a lot of participation above this level. Anyone who newly got involved up here on the long side is clearly screwed, right? The best swing failure would be, in this case, this being relatively thin, so the bid not following up. So if we had a bunch of zero prints or just more of a vacuum, and a lot of buying on the top right, right? So bid side is full, or no, excuse me. The ask side on the right side shows a ton of aggressive buying. If you have a lot of new buyers at the high, and you're looking specifically at an area, I would say, okay, this is a good swing failure when we start trading below the activity, right? So I'm not just saying, let's make this a little bit more concrete. Here's a prior high. Price comes up through the level, breaks it, a bunch of participation comes through. Well, I'm not saying, oh, swing failure right away. I'm only saying swing failure when we trade below where the activity comes in. Because what I'm saying is this is a trap setup. Well, I need to get involved when those trapped players are going to be puking, right? Or when we're starting to put them under pressure, right? Their pain point is under their trade, right? If the market comes back above a level like this and it holds, well, they're still in good position. And if it continues to move up, well, then anyone who sold them this with an offer is going to be closing their position out, helping this move up. And that's why I sort of called that move spiking up a little bit more earlier. But the benefit of looking at a footprint is that you could see, you have a little bit more insight into where the pain point exists or where that activity came in. So I could say, well, in this case, let's say that this was very one-sided and there's a ton of activity and this was a swing failure. Well, do I need to put my stop all the way up here? A couple $100 above this or 1% above it or 1 ATR? Well, if all the volume came in right here and I'm saying that that's the trader or those are the participants that I'm looking to see get squeezed, well, why would I have my stop way further than that, right? Especially if this is after one big move and this is an exhaustive thrust through. If anything, my invalidation is probably that level, right? So price transitions, from left to right, just to give you an idea. Move up, swing failure, buyers come in right here. Now we trade below. A lot of times I hammer this. So I'm trying to lean on this hard with size. You want to have obviously other things line up, right? It's not just in a vacuum. This might be a setup that could be arguably still bullish, depending on the context. But I'm slamming on this, right? Expecting this to unwind very quickly. The more size, the more open interest, the better, right? But if we, let's say, see this volume come in, price comes back to this high, and then let's say the next candle right here opens up, and looking at a low time frame one for this, and we see sellers come in right here and this holds, well, shit, if we start trading above this level now, they're not offsides, right? So I'm not really going to hang on to that position. So a lot of most of my stops are from the Blockroots website. In your description is not working. So I said you have to put www. So I'll do it during the stream. But most of my stops are manual, where I just pull myself out of the trade because of that. Because I'm looking at, I have an idea of why I'm getting involved based on, a particular area within market structure where, in this case, a lot of activity came in. Usually that's going to be more or less a pretty big part of my trigger to get involved. And then also it's going to be a pretty big reason for me to get out of the position if it's recovered. So that's why it's like market structure is very useful, price action is very useful, but on its own, it's not, because you could have a candle. Let's say that this is your swing failure. And let's say the breakthrough here is a candle like this. Wait, excuse me, fuck. Let's say you have a candle like this, big wick. So if you're looking at a candle alone, you don't know whether or not it's substantial, right? Whether or not there's a really good trap to take advantage of. One can look like this, with a ton of buyers caught at the high, and the other one can really just look, could look actually like this. So buyers got aggressive, we burped through the level, and when it was sold, the bid absorbed some activity right there. So I really want to see that it's in a trap, and as clean as of a trap as possible. And in this case, the footprint's just a lot more helpful for a million reasons. I mean, that's just one. That's very that's oversimplified. So quick short. This was the last trade that I took. We'll just go over that. More low time frame than anything. I mean, you can see it briefly right here. So I mentioned on Twitter right here that this wasn't done, and that was when we were at 44.50. Just because it's unlikely that, in this case, we returned back to, I have it on the wrong screen. Go back. So this move right here, so remember today's value, okay? This move from the low was all the way back into the top of value. So, not going to be holding a position through there necessarily, right? This is an area where you should expect that if you just rotate it to the low of the range, this is the high end range of the range in progress, right? The day's still in progress, so it's not as concrete. But a really extensive move like this from one side of the structure to the other, and you see this, it's not usual. It's not usually the case that aggressive sellers are going to be the ones that cause the turn. It's usually the case that buyers getting absorbed will be, right? So passive sellers will shape market structure rather than aggressive sellers. So on the way up, this was partially longs closing out, and it was partially aggressive sellers opening. And what this shows you is that when they opened, price was able to stay at this level. So what I was just expecting was price to just push up slightly more. And then it became much more clear that we are seeing more activity at the high more than anything else. Right, so this was just a very quick short, and it was closed out when when we nearly tapped today's VWAP. So just showing you based on market structure. One sec. This was right here. So again, this is, just put the drawing tool on. This is them aggressively selling and then expecting that we squeeze up. Once we squeezed up and took out that high, basically just leaned on this, expecting that we would at least return back to VWAP. And that was actually back here. Expecting that we'd return back to VWAP and ended up pulling the position when it looked like there was some selling coming in that was getting absorbed. Right, so again, this concept of absorption is a little bit more obvious. Again, when we look at the footprint, you just had a lot of aggressive selling come in and price, instead of just continuing to nuke down, right, we see that the price was able to hold. Okay, so again, the concept of price being bid right here, this is an example of price being bid, right? So move down, sellers driving this down, not much selling at the low though. When price breaks up, now we're trading above this activity, and now price is able to hold this sort of 44.50 level. And instead of selling coming in and dragging price down, we see it again, just for example right here, you have selling trapped at the low and price is still able to hold this region. So now, unless, I'm currently in no trades right now, besides just being exposed to the underlying. The next setup ultimately would be, and we'll just clean things up. So today's value, right, if we look at the last 2 days, today's value, yesterday's high, you can see that there's confluence between that region. So first high, big deviation spike. So now if we're back above, something like 44.3, I just think we get the next expansion period. So I would say, okay, if you're back above 40, if we're back above this region now, after we saw all of that activity get trapped up there, and price is staying bid, so I actually expect this to happen. As long as if we continue to grind up and we're trading back above this region, you're probably looking at minimum, a move back to today's highs, right? Because if you look at today's structure, it's not like it was substantial at all. So the move down was very one-sided. So this on the way up shouldn't really act as resistance. We should pretty much just zip up to 45. And then I don't think that we are going to be stopping before, again, upwards of 46, 47. And then just to show you what I mean by Blockroots working, www.blockroots.com. There you go. I know it's not centered right now, but you can see it there. Just get rid of these. All right, questions? Yeah, I'm just trading BTC right now. So for the last day, I haven't traded any alts today. So, and just an example of what looks like absorption right now. You could see right here. So this region right here, just look at this TPO chart. That's today's POC, right? Today's point of control. Right back the top of yesterday's consolidation before that spike up. And right now you have selling coming in and price is able to stay bid. So by staying bid, I just mean that we're able to auction above still. So if you have a lot of selling come in, right, sell orders, buy orders, it should move the market. You see longs closing out, you see shorts opening up. The idea is that either way, the bid, it doesn't even have to be the perp bid, the spot bid, a bid is keeping this leveled right now. What's up, Dave? So I went over yesterday why I look at Bybit. I was trading on Bybit for a really long time, so I think you should um, chart the instrument that you're trading because ultimately those lows and those highs are going to be the ones that you're going to be most focused on. But I think in terms of paying attention to order flow, Bybit is very useful for some of these really trappy setups. You see a lot of ape-like behavior, a lot of overheating on Bybit on both the long and the short side. So those opportunities present themselves often where you could get on the other side of that. But I think in terms of like total market interest and larger positioning, I think you have to pay attention. This just is going to speak to, for those that don't like, let's say, trade on FTX or Binance. Let's say you just trade on Coinbase. You should be keeping an eye on positioning on FTX and Binance because those are the leading exchanges. So crypto's tough because there's a ton of exchange fragmentation, and you have to follow what leads the market and what leads price discovery. And if you're trading on one exchange, though, you should absolutely be taking your entries based on the structure on that exchange. No, so value area is the sort of out of the box setting is 68%. One standard deviation if you're looking at like a Gaussian distribution. So, right, that's where that comes from, right? So price wants to find value. Price seeks value. Okay, when price is balanced, when it's ranging, we say that it's found value. When price is ranging, and we have a balanced distribution. So this is not very balanced. This is not very balanced. But over the last 2 days, it's becoming more balanced, right? You can see that you have an inside structure. A structure like this is balanced. So this we would say is a period where buyers and sellers found agreement, right? More or less a stalemate, very balanced structure. Value had been established between 41.7 and 41.3. The chart does it for you. So if you look at a TPO chart, it's marked off. So it's going to be either 70% or 68%. It's a negligible difference, right? Because it's never that you're going to be focused on such a precise level as much as it's a zone. So this is your value area where the TPO color is different. And what you're ultimately looking at is if price is balanced, if you have multiple periods of inside structure, you have a composite. Break from balance setups occur when you no longer have absorption of buyers at the high or absorption of sellers at the low, right? So a break is price being accepted through the balance towards the value area high, or outside of balance through the value area high, or outside of balance through the value area low. And when a market is trending, it's said that it is absorbing new information, right? Because otherwise markets, they should be, we know they're not, but efficient markets would be very balanced, right? Efficient markets wouldn't really move. So when price is balanced and it's ranging, you could look at it like temporary periods of not just inactivity, but efficiency. And then new information is absorbed, and it doesn't have to be new information necessarily, but it's the idea that one side is overwhelming the other, and there's no longer, and fair value is being redetermined somewhere else. Macro. So let's go over a few things. Listen, I'll say a couple things. One, at the beginning of rate hikes, markets don't usually tank. It's usually well into a period of rate hikes. For the last 30 years, we've had much higher rates than they've been declining. So if we just look at, for example, make sure this is lined up. Just go to chart. You see there's a trend, right, of lower and lower rates, right? So going all the way back to 1980. So we can only raise rates to a certain point because at some point, companies that are in debt are going to be fucked. The Fed is going to be fucked because they're the biggest customer. The United States would not be able to satisfy its debt, right? And this is probably above 4%. So you can see the trend has been one of us being on a downtrend over the last, again, it's going on 40 years. I don't think this is going to change. I don't think we can change this. What is worth noting is, yes, we had a taper tantrum, but during these periods where rates were going up, markets were going up as well. So markets have been able to go up in the face of rising rates. So that's one thing. Another thing is that, yes, there's been a ton of liquidity added to the market the last 2 years, right? QE has been a newer experiment as of the last 20 years, but it's been just insane the last 2 years, post-COVID. Now, it's not being completely removed, right? It's being reduced. I doubt the Fed is going to be acting or being too abrasive, because the index is not, it's one, it's not a reflection of the economy. Two, it's a political tool. And three, it's referred to as a happiness index for a reason, right? People in the United States, and the United States just equities, most of world markets focus on United States markets, right? So yes, there are other markets, but for the most part, it's the S&P that's looked at, right? The S&P, the Dow, the NASDAQ. These are what everybody is looking to get a general feel for things, right? Whether or not that's correct or not doesn't matter. It's what, again, swings votes to some degree also, right? It's used as a political tool. So we can't raise too much. We can't destroy people's 401ks, right? They can only do so much before they're really just put in a position where they ultimately have to start backstopping the market again. And that's usually around 20%. So I don't think that I don't want to go too much into this because it's not my area of competence, and I always say how I hate talking outside of what is my area of competence. I think it's like a thing that is all too often done by people who have no business talking about the subjects. I don't think we're looking at any kind of major market decline. I will just say that, if anything, it's really worth noting how the markets and retail are so privy to what's taking place in rate markets. This has never been the case, right? It's never been the case where we've had retail talking about rates as much as we have them talking about it now. So I think that a lot of it is actually being priced in. Our market's very shaky. Is there a case to be made for markets being very shaky this year? Because yes, we're taking out the ridiculous liquidity we were injecting, and now there's more of a organic bid that's required. Yeah. Is there a lot of uncertainty because of the Fed being much more active and there being talk of more rate hikes, and there's constant battles that are taking place on the media, right? On the financial media. Yeah, we're going to see markets are more sensitive, more volatile, sure, but I don't think we're looking at anything that's cataclysmic. Just a good amount of volatility. Again, they can't raise rates beyond a certain point, right? So the Fed can't. I don't think they could raise rates above 4%. And I don't think that we would see anything that's in excess, honestly, of what we've had back in March 2019, which is, 2.42%. So that's what I think. I think this makes for shaky markets, but again, it is what it is. BTC trades like a chameleon. It's a macro asset now. Sometimes it's a store of value. Sometimes it's a hedge against inflation, and for the most part, it's a risk asset. So it trades along the lines with equities. If equities continue to go up, make new all-time highs, then BTC should do the same thing. Except BTC and crypto has less penetration overall. So if anything, it should continue to outperform. They're already talking about like 75 basis point rate hike in June, or 50 basis point rate hike is already being priced in March. So the more aware of these things the market participants are, the more likely it is that we're seeing that behavior reflected in price action currently before it actually takes place. And if anything, you just saw the best example of that, or just general market positioning, when non-farm payroll came in just blowing expectations out of the water. Showing that the economy, it's in a position where they could potentially tighten with a lot of leeway. They have a lot of runway, and instead of markets just shitting the bed in anticipation of what could be a green light for more tightening and larger hikes, instead of the market shitting the bed, it ripped. So no, I haven't tried a 33% value area. I designate my range highs and range lows all the time either way. So no, but if we're within value, the first area that I'm looking to is value area high and value area low. So I'm just marking off areas where I think participation might increase. This is just my general approach. Marking off areas where I think participation matters. And if we're between two levels, the first two ones I'm going to look at are the ones that are nearest. Otherwise, I think people are too forward looking and they look like way past levels. And yeah, so I mean the S&P, like I said, back above the 200-day. So your CTA trend followers are, redeployed again. Any kind of systematic trend follower, they're not thinking about it. They're just getting involved again. And when we lost it, that represented a significant amount of liquidity that was pulled from markets, which always makes for crappy behavior. Yeah, exactly. So I paper hand the shit out of things. Mostly alts. But no, with make all jokes aside, I just change my mind immediately. Once I see something that even, because a lot of the time when and this is not something I've dealt with in years, but when you're newer, you'll get the feeling that something is wrong or that you should maybe flatten or change your mind, but you'll hold out a little bit longer. I don't hold out anymore because my trading is so leans so much on positioning. Unless it's a major high time frame level that we're revisiting, and then I'll usually just buy pretty indiscriminately or sell pretty indiscriminately, knowing that I'll get a meaningful response, at least in the short term, and then look for absorption over the long term as things progress. My trading is so participation based that if I'm looking at a level and I'm saying this level is important because XYZ sellers came in and it's holding, well, once we lose it, like why, no reason for me to hold it. Like reevaluate somewhere else. Not going to reevaluate my money on the line. But a lot of newer traders, they see a position go past their comfort zone, or they're out of their comfort zone, and then they think like, oh, let me just hold on a little longer. Maybe I'm wrong. Maybe my stop placement's wrong. Maybe price just needs more room to breathe. I just changed my mind almost instantaneously. And then what that means is, and this is something that you just have to be willing to do, like if I have a signal. And it happened multiple times at the swing low that we just had around 43, where I was long initially. I got short, and I'm like, this looks like it's gonna puke. And then next thing you know, I'm holding a long, thinking this thing's gonna run. And it's because the things are evolving as price is moving from left to right. And one thing you have to be willing to do is to not think that you have to be right the first time around. So if I could get in and out of position 3-4 times. Flatten, get in, flatten, get in. And there's no reason why I shouldn't get in the trade if it starts to work out again in my favor. There's no reason why you have to be right the first time around. No, Quant Tower is just about execution. So just using the ladder. I've gone over how I've used Quant Tower in the past. Setting up one ladder with a wider aggregation just to be able to scale in fast still, but without having to point and click on the chart. And then one ladder at a basic aggregation, 50-cent spread. And it just makes execution very quickly. Execution near frictionless. You could use hotkeys on it too if you want. But I haven't traded all today, so I'm sorry, guys. I haven't even looked at them. Couldn't even tell you what was up. Ooh, wow. Ripping. But we just talked about this yesterday. Back within a prior range. You're just looking at the highs now. So AVAX was listed on, was it Upbit yesterday? And it ripped. But to be honest, guys, I I haven't even looked at alts today. Am I still holding near? No, not still holding near. Yeah, not still holding near. I mean, I'd much rather see that. I'd much rather see that we're able to trade back within this prior range instead of getting absorbed right there. It's just this was one of the more recent rotation plays, right? Phone, and those you have to be really mindful of. One, the narrative, price changes. The narrative changes before price because price has momentum. Um, but once the narrative is done, like you don't want to be in a rotation late. You don't want to be the last person, the last person standing. Um, so what you would want to do is, like I always say, like you just want to stick with what continuously shows strength, right? And if something is kind of wishy-washy around a key technical level, while plenty of other alts are overtaking their levels, like I don't know, it's just not a market where I really can hold with a lot of confidence. For example, I had two positions in near here where I ended up marketing in, placing limits below. One of them I wasn't filled, TP'd higher. The other one I set, and I think it was partially filled, but ended up closing position anyway. So it's funny because like this happening earlier was what I would have been looking for, right? I mean, I was looking for a retest into this gap, but what I was expecting was this was during a period of momentum, like markets are moving up fast. Some things are squeezing through their levels. Maybe this pulls back down to here and I get a full fill and then we move up. Now that it's kind of like taking its time at the level, I think it's just well enough to find that, if we're back above 1350, I'll just take the range trade back up to like 16 something. Well, one thing I also don't want to do is like get too swept up in the general market right now where everything is going up again and not being mindful that it's it's the case that a lot of things honestly should at some point bounce, right? So you'll see a lot of, like for example, sand, yesterday during the stream, I was talking about it being at the underside of the structure, but it's not a ripping bull market where when you see a candle at the underside of structure, you can make a case for actually sometimes buying, right? If it's grinding against a level. I'd much rather get in trades within, in this case, on a recovery of the level and holding the level than, I guess, be overly captivated by the energy of the market and just forget that shit dropped a lot and it should bounce now. And then it could just continue down. Like a lot of alt charts still look shitty. I mean, if you looked at Sol, for example, I mean, weekly chart, below any major structure, right, hanging in the middle of a gap. This is a nice bounce, but bottoms take sometimes a long time to develop, and the first bounce is often the one that is just the dead cat on the high time frame, though. So it could be that you have weeks of sideways behavior, and people are buying the highs thinking this is just going to shoot straight up. Now, maybe it does, right? But chances are that they don't. Chances are that prices across the board don't just V-shape reversal when we have like shakier legacy markets as well. But with alts, I lean heavily on weekly structure. So, for example, you see I have Ray marked off down here. I'll probably buy Ray down here. Even if it's dog shit, weekly loss of a level, weekly return to a level and recovery is usually going to offer a short-term bounce. And we know short-term bounces for alts can be like 30 to 50%. So I mark my levels off. We're in a downtrend across the board. And I'll wait. I'm not going to chase anything right now. It's not that kind of market. Well, those are going to wrap it up, guys. I think I covered pretty much everything. I just wanted to use this stream to, it might have been boring, to go over the ideas behind those 3 trades. Just because I was vocal, I was sharing a lot today on Twitter as I was trading, which is difficult, but when you have your screen capture to a single keystroke, it makes it pretty easy. Although I knew as I was doing it, I was like, this is a fucking bad idea, man. Because every time, so when I'm trading, I'm keeping my hand within a certain area based on what I think might be the moves, right? I mean, sounds stupid, but every little bit of screen space that I have to cover with my mouse is bandwidth, right? It gets in the way. It's friction of me making a faster decision to get in or out. So when I do anything while I'm trading that's not trading, it takes me out of sync. So when I get in a trade, I'm like, okay, I'm going to share this. I'm literally thinking as I'm, snipping the screenshot and putting it on Twitter, like, oh, fuck, I hope this does not rip against me right now. Because like I said, my setups, a lot of times I'm pulling myself out of the setup manually. So, but I think I'm going to wrap it up, guys. I mean, just to reiterate, the shallowest pullback possible speaks to more bullish behavior, at least. And I'm saying short term, but I know this like fucks up people because when I say scalp, sometimes I also mean like take trades that last for they could last for hours, but I'm just talking about intraday trading. So when I say short term, I don't mean 5 minutes. I don't mean 4 hours. I mean just the next couple of weeks. So we have short-term trends within a year-long range right now, right? So this transition is very bullish so far, as long as 43 holds. If we're breaking down around 40, 41.5, I'm going to be requiring a lot more from price than just leaning on the fact that it looks, that it changed down here and this was the response we got off the lows, right? If anything, and just to go over something real quick that I think is a good teaching moment, is why you should record data, and I should get back to Python myself. And I used to have a sheet that was 4 years of data, and it was by a guy named Jeff, who was a popular guy on TT for a really long time. This is going back, I think the sheet was, he put it out in like, I don't remember, 2018 or 2019. It was dated, but it's getting into what I'm getting into now. So I ended up having a friend give me an updated version. When you have candles that are, this is I forgot, what this was, but this was probably a 3-4 sigma move. This is one of the biggest moves we've had in over a year. So a 10% candle, just think about it like that, okay? This is a pay attention kind of candle, right? This should have your attention. When these occur to the downside, the same thing, right? Unless it's the last move into a level, right? If this is coming off of a 50% drawdown after we've had this kind of positioning at the low, again, after non-farm payroll, this is a fuck you candle that means pay attention to the bulls, all right? So what usually happens is, and this is where I wanted data, there's usually a lot of follow through from these where, and I've said this before, sometimes it's, to have data, you're able to lean on data in a way that you don't have to observe price as much, where you could say, all right, so in the last 3 years, after a 10% move, 65 to 70% of the time, the following 3 days, we saw prices rise by insert, an amount, XYZ amount, 10%, 20%, 30%. If you have information like that you can lean on, I mean, at that point, it's very easy to define at least just general exposure, right? And that's what I was getting at down here, because I was thinking, all right, so now we have, I mean, at this point it was really obvious because all the criteria that I normally look to as my last bit of criteria, like systematic stuff, which is the 20, all of this stuff was really just lining up. But even without that, a 10% candle after a significant drawdown in this kind of positioning, what I mean is a lot of times you could basically, there are some times where you could just put on a position and say, I should probably not look at my computer screen for the next day and a half. I've said it a couple times before. A couple months back, I said something along the lines of, one time it worked out, one other time it didn't. Chances are that we are higher 30 days from now than lower, right? So put a number on that, assign a probability to it, and you could define a position around it to some degree. And that's my point is that that's always helpful, right? I mean, it takes away some of the work. Like if you know that chances are that there's an 80% chance that in the next 3 days prices are going to just be higher, right? Then it's like, all right, so that's kind of a no-brainer, right? I'll put on a reasonable size volatility-based stop, and I'll set a position and forget it, and you know, not for nothing, I'll come back in a day, or at least just not worried nearly as much. All right, guys, that's going to be it. Thanks for tuning in. It's always a pleasure. I'll go live tomorrow, probably same time, but we'll see. All right. Yeah, and don't get stuck in, you know, very biased areas of CT. Be fluid. Be like water. Adios.